and transfer pricing. Right? Let me share my screen here. Okay. So allow me to also share my sales spreadsheet. Divisional performance and transfer pricing. I'm sure I have written that as a subheading. Tenchi, how are you?
I'm fine, sir.
You know, from Gwanda, I'm sure you were born and bred in Gwanda. So are you able to speak Shona?
I'm from Plumtree, not Kwanda.
Well, but oh well, geographically it's the same area. Are you able then to speak, are you able then to speak Shona?
No, I am not, but I can understand if one is talking.
You can understand?
Yes.
Saka ndikakuti urisei shamwari ndakusuwa unenge unoziva ndati
You saying, how are you, friend? I missed you.
saka uri boss. rega ndisataure zvakawanda because kudzasha anobva atoziva kuti saka munhu aritori bhoo kunyepe kudzasha.
handisi kuzvinzwa.
Kudzashe has decided to go diplomatic. But what Kudzashe is saying is he has heard it. Okay, cool. So what we are saying, you interpreted it wrongly. What I meant was, I want you guys to pass. That's what I meant. I didn't, that's not what you said. Okay. It's because you don't understand Shona. So allow me to keep my explanations to English. Allow me to okay, I've already started recording the lecture, so let me not say much of the stuff. Today's discussion is divisional performance and transfer pricing. Divisional performance and transfer pricing. Divisional performance and transfer pricing. That's today's discussion aspect. Now, this discussion item is segmented into quite a lot of other sub discussion items. And amongst the sub discussion items, the first one is scope of divisionalization. Right? Scope of divisionalization. We do have what is called cost center. Cost center. Cost center. Put a dash and say a responsibility center in which the manager controls costs, that's a cost center. So if you are a manager of a cost center, performance is measured in using cost metrics such as variances. So if you say you are a manager of a cost center, we are saying you are merely in charge of your responsibility is controlling of costs. If you are a cost center manager, your main responsibility is to control costs. Now there's what is called a profit center. Revenue center. Revenue center. Okay. Responsibility center. Responsibility center. Center for controlling costs and for, let me not say for controlling costs, but for generating revenues. That's a revenue center. You are a revenue center manager if you are merely responsible for generating revenues. Then there is profit center. Profit center. Profit center. The manager is responsible for profit generation, for revenue generation, and cost control to earn profit. So if we say you are a manager of a profit center, you are a manager of, you are responsible for revenue generation, and you are also responsible for cost control with the resultant aim of earning profits. That's profit center. And then we have there are actually four. There's cost center, profit center, revenue center, and investment center. This is all the attributes of profit center, and in addition, the manager responsible for, the manager is responsible for making capital expenditure decisions, CapEx decisions. The manager is responsible for making capital expenditure decisions. So what's an investment center? An investment center generates revenue, incurs costs, and in addition, as a manager, you are responsible for making capital expenditure decisions. That's an investment center. So what distinguishes an investment center from a profit center is that a profit center manager is responsible for controlling costs and generate revenue, but a profit center manager doesn't make capital expenditure decisions. No. a profit center manager is not responsible for that. You do not make capex decisions if you are a profit center manager. Now, but if you are an investment center manager, so what I was saying is a profit center manager, you don't make capex decisions, yes. But if you're an investment center manager, you control, you earn revenue, control costs, and in addition, you make capital expenditure decisions. You get that? Right. So actually, like let's say, let us have profit center. Oh, okay, let us have as a subheading alternative measures. Alternative measures of divisional profit. Measures of divisional profit. You know, if you want to measure divisional profit, there are quite a lot of measures that we can use to measure divisional profit. Alternative measures of divisional profit. But allow me to check how many students do I have in this lecture. Oh, quite a lot. TM, what's TM? Tabeth Muru, Tenchi, Molen. You know, Molen, I confuse you with someone I know, so I have to check your because your face looks very familiar to someone I know. You know, as you say, I do own a BL, so I'm coming from my BL. I have a BL, so we are selling beers from Backdoor, and yeah, it's quite. I was there since morning. So I wasn't drinking. I know I don't drink beer. I drink water. This is water. I'm waiting for a blessing for me to drink beer, because currently I'm just drinking Black Label. I'm yet to drink beer, but I'm drinking Black Label anyway. Okay, alternative measures of divisional profit. How then would you say this is divisional profit? You have written this as a subheading. You say sales. Now, containing sales, you have internal. You know, by internal we mean interdivisional sales. Interdivisional sales. That's internal sales. Interdivisional sales. And then we have external sales. External sales. You know, when you are saying external sales, these are sales you are making to external. Then you say less variable costs. Variable costs. And then less controllable fixed costs. Controllable fixed costs. The answer you get after sorting out the mess is controllable profit. Controllable profit. Right? controllable profit. Now, I don't know why I ended up underlining both sides. Controllable profit, and then you say less non-controllable costs, less non-controllable fixed costs. The answer you get then is divisional profit before tax. Profit before tax. Right, so you have divisional profit before tax. Now, what you have here is how when we say divisional profit, notice, Kudash, if I say you are a divisional manager, the bottom line is you must ensure that your profit is measured based on things that you can control. Clearly, I can't say you are a divisional manager and I begin to measure profit based on revenue and expense items that you can't control. It doesn't work that way. It really doesn't work that way. If I say you are a divisional manager, suppose we have a division in Gokwe. If you are a manager in Gokwe, your performance must be measured based on the revenue and expense items that you control. And we call that controllable profit. You can see that. That's controllable profit. It's something that you can control. You get it? Then divisional profit before tax, as you can see, it includes some of the items in terms of revenue and expenses that you can't control. Divisional profit before tax, it includes some of the revenue and expense items that you can't control. All right? All right? Allow me to send this message. Okay. Right? So I'm done. So what I was saying is this is like, your performance must be measured based on profit that you can control. And we call that controllable profit. If we include non-controllable costs, non-controllable, oh, no, I've done it wrongly. I was supposed to say here less controllable fixed costs. Can you put after saying less controllable fixed costs, Oh, well, it's actually correct. Don't worry. Less controllable fixed costs, you get controllable profit. And then non-controllable fixed costs, you get divisional profit before tax. So what it means is divisional profit before tax takes into account those expense and revenue items that you don't control. Right. So what are the advantages of a divisionalized entity? Advantages of having a divisionalized entity, meaning an entity where you say if you are a profit center manager, you are responsible for generating revenue and controlling costs. If you are a revenue center manager, you are responsible for generating revenue. If you are a cost center manager, you are responsible for controlling costs. What are the benefits of divisionalization? You know, the benefits of having a divisionalized entity is that as managers are, it will result in a situation where managers' performance is measured based on aspects of performance in which they are responsible. That's a benefit. Another benefit is that, a benefit of divisionalization is that it helps managers to make decisions which will attend to customers. So there's a benefit of better customer service because managers which interact with customers, which are at the point of customer service, are able to make decisions, and in so doing, such managers are able to make better decisions. So these are the benefits of divisionalization. All right. Now, so you have that. Now, right? It's a sub. Oh, okay. Let us say, evaluation of divisional performance. Evaluation of divisional performance. Evaluation of divisional performance. Quite a lot of things to discuss here. The first one is, write this. So the first one is a controllable profit. Controllable profit. That's the first one. Just write this. A division with a higher controllable profit assumed performing better than a division with a lower controllable. So it's a very important thing. If you are comparing performance of two divisions, a division with a higher controllable profit, we say it is performing better than a division with a lower controllable profit. But there are disadvantages in doing that. However, controllable profit absolute measure. It's an absolute measure of performance. an absolute measure of performance, meaning just a figure. And cannot, and it can not be used when evaluating performance of different sizes. So you have that. When you are evaluating performance of divisions of different sizes, you really can't use controllable profit as a performance measure. Controllable profit it's like this. You make a profit of $20 and I make a profit of $10. Like these are controllable profit. Your controllable profit is $20, mine is $10. Does it really mean that I have underperformed? That's a good question. Under the circumstances, would that really mean that I have underperformed? So under the circumstances, you do notice that controllable profit is an absolute measure of performance. It's not easy when you are evaluating performance of divisions of different sizes, because your size might be $1 billion entity and my size might be $1 million entity. So if my controllable profit is 15 million and yours is 1.2 billion, it does not automatically mean that you are performing better. That those are the weaknesses. So what we then do is we make use of, so let us have base information so that I save my time. Base information. Base information information we are going to use in the coming discussions. This is base information. Let's say division A, B. Then we have controllable profit. Controllable profit. Controllable profit. Now you understand what controllable profit is. Controllable profit, profit yaunowana after what deductor kana kuti waedha zvinhu zvaunocontrola. After what deductor kana kuti waedha zvaunocontrola. Saka ukanzi tomboti profit for the year is 2 million, but wozwanzi 2 million iyi takanga tabvisa 5 million yekuti inini handiicontrole. Papabviswa 5 million yekuti inini handiicontrole kuti tiwane 2 million. Saka controllable profit chii? Unoedha back 5 million ka, because 5 million handiicontrole yakabviswa kuti tiwane 2 million. Saka controllable profit is 7 million. Controllable profit is profit which arises from revenue and expense items that I can control. That's the general thing there. Controllable profit 100, 75. Then you have net assets. Net assets which is equals to capital employed. Capital employed 200. 140. Cost of capital. Cost of capital capital. Cost of capital is 10%, 12%. All right. I'm sure you copy. Copy that. Right. So there you go. Let us have comments. Comments. Right. Number one, using controllable profit as a performance measure. Controllable profit as a performance measure. Performance measure, comma. If you are to use controllable profit as a performance measure, for example, which division has performed better? So you can say division A has performed better. Using controllable profit as a performance measure, division A has performed better. That's a better performance there. Division A has performed better. If you go by the controllable profit as a performance measure. Then another point is, now I have told you that division A, controllable profit ayite, because the absolute measure of performance. You know what we mean by absolute? Nanyora point, pana. Absolute means controllable profit is just a figure. Now, if controllable profit is a figure, it means you can't use absolute figures to measure performance, because the question is, what if these divisions are of different sizes? What if they are of different sizes? So what it means is controllable profit is not reflective of those sizes. You get that? So you then have what is called, so you can say controllable profit is not ideal. Controllable profit ideal if divisions are of different sizes. If divisions are of different sizes. So what you do, you have a return on investments. Return on investments. Return on investments, which is ROI. Return on investments. So return on investments is basically meant to mitigate the problems associated by controllable profit. If we say controllable profit is not ideal for divisions of different sizes, if we say return on, controllable profit is not ideal for divisions of different sizes. So what then is ideal? We have return on investments. So write this. This measures controllable profit. This measures what? I'm not teaching you from home. I'm teaching you from 100 kilometers home. So you bear with me should you happen to encounter problems. This measures controllable profit. Controllable profit. Nditori kumusha vanhu vari kutoshaya kuti bamuninotaura chirungu, so ndangoti ndingogara pavheranda rehosi ndikutokutichai ndiri pavheranda rehosi. This measures controllable profit per dollar of capital invested. Dollar of capital invested. Right? Per dollar of capital invested. This is what we mean by return on investments. It's actually controllable profit per dollar of capital investment. So it is calculated like this. ROI equals controllable profit, controllable profit over capital employed. Over capital employed. Now, capital employed, it will be like where capital employed is or it can be given. Employed is at the beginning, or it can be given. That's the issue. Write this. Still, write this. There is also average capital employed. Also, average capital employed, which is equals to opening capital employed plus closing capital employed over 2. Opening capital employed plus closing capital employed over 2. If the examiner says average capital employed, that's how you get average capital employed. Opening capital employed plus closing capital employed over 2. Right? Well, it's okay, guys. I'm just looking at something else which is quite cool. So that's average capital employed. Now, we have got base information there. So let us say division we have got A, B, we have you do have controllable profit, controllable profit, controllable profit you have equals, those are the controllable profit figures, 175, and then you have got net assets, capital employed, capital employed, capital employed, capital employed equals these figures here. All right, capital employed, and then ROI, return on investments, ROI equals this over capital employed. And what would be your ROI under the circumstances? The ROI will be 50% equals this over this. So this is your ROI. So you can see from the information given here that using ROI as a performance measure, using ROI as a performance measure, comma, division B is performed better than division A. If we are to use the ROI as a performance measure, you can see that division B has performed better than division A. Notice, when we used controllable profit, division A performed better than division B. And now we are using ROI. Division B is performing better than division A. So what it means is, the beauty of ROI is that it is a relative performance measure, meaning it computes everything per dollar. Whatever it computes, it's per dollar. So when it's saying 50 cents, 50%, it's 50 per dollar. So ROI is ideal in interfirm comparisons because it computes everything to the lowest common denominator. In this case, it's per dollar. You get it? That's ROI for you, right? Now, let us write residual. So what it means is, write this, however, however, comma, a higher ROI may be a result of, a higher ROI may be a result of, now notice, ROI means controllable profit per dollar. And it is important for you to understand how we calculate net assets. Net assets equals capital employed. So what happens is, if ROI is higher, don't necessarily take it to mean the firm is performing handsomely. There might be other issues which may result in a higher ROI, which have nothing to do with performance of the company. A higher ROI may be a result of one, right? Failure of the division. failure of the division to replace its assets. To replace assets. Failure of the division to replace its assets. E.g., if the NBV, net book value, if net book value of assets, if net book value of assets is low, comma, a division may report a higher ROI, This will at the expense of long-term success of the company. Success of the company. You know, I want you to understand this. You know, if a company has got, if a division has got a higher ROI, notice ROI equals controllable profit over net assets. So let's say net book value is low. In other words, your net assets is low. What will happen to your ROI? It will be high. So don't necessarily equate high ROI to better performance. Don't necessarily equate high ROI to better performance. Because when you have got a high ROI, it does not necessarily mean performance is high. Because high ROI may be a result of a division not being able to replace its assets. You get it? So as a division, you must replace your assets so that you report a higher ROI. So this is so important. Another point is ROI is an accounting measure and can be manipulated. You know, ROI is an accounting measure and it can be manipulated. You know, when we are saying controllable profit, as you can say, it arises from things that a manager can manipulate, like depreciation figures. A manager can alter depreciation policy to affect the net assets. If a manager alters depreciation policy to affect the net assets, as a result, you would notice that a division may report a higher ROI, not because that division is performing, but because the manager has altered the net assets for the division. Another point is a manager, write this, dysfunctional behavior. That's another point. Dysfunctional behavior. Dysfunctional behavior. Let's put a dash and say a manager may be reluctant. A manager may be reluctant to invest in new assets. In a bid to avoid a reduction in divisional ROI. In a bid to avoid a reduction in divisional ROI. This, however, affects long-term success of the company. Long-term success of the company as new assets are not being invested. You know what? I like this point. You now understand what ROI is. ROI means controllable profit per dollar of capital invested. Now, suppose you are paying bonus to managers on the basis of ROI. Managers will be reluctant to invest in new assets because once you invest in new assets have got higher value, so that will result in a reduction in ROI. So managers may try by all means to avoid that. So, if managers are reluctant to invest in new assets, it will actually result in a higher divisional ROI, meaning the ROI will not be affected. But the danger is, by failing to invest in new assets, the company's long-term position will be affected. Can you imagine a situation where a company is not replacing its assets? A company is not investing in new assets. What will happen to the long-term position of the company? It will be affected. So we call that dysfunctional behavior. What is dysfunctional behavior? It's a situation whereby, as a division or as a manager, you are trying to maximize your managerial or divisional performance at the expense of long-term success of the company. So you need to understand that. So how do you mitigate ROI? How then do you mitigate this ROI? Another point is still on ROI. A higher ROI, write this, a higher ROI, AB, a result of a company in straight line depreciation, whereas the other reducing balance depreciation, Now, if a company is using straight line depreciation, do you know what happens? Its assets depreciate faster with larger amounts. So such a division or a company will result in a higher ROI because assets are depreciating at a higher rate. And then, for comparison purposes, before you compare whether this is performing better or not, check whether their depreciation policies are the same. Because if your depreciation policy is of such nature that you reduce your asset values by a higher amount, it means the carrying amount will be lower and your ROI will be higher. So a higher ROI does not necessarily mean you are performing. Perhaps your depreciation policy is depreciating assets faster, and in so doing, resulting in a higher ROI. Just a minute, I'll be back. division, we have division, division A and division B, and then we said controllable profit, controllable profit, it's 100 here. These are the figures, right? 75. And then net assets, capital employed. Are these the figures, Nigel? Capital employed slash assets. Nigel doesn't want to talk anymore.
Yeah, no, yeah, they are the figures. They are the one that you have used.
Are you not seeing that? I don't forget. Cost of capital. Cost of capital was what? 10% and 12. 12% and 10%.
50% and 57%.
Cost of capital.
Oh, cost of capital. Okay.
Right. So actually, we said here, using controllable profits as a performance measure, you can see that division A has performed better than division B if you are using controllable profit as a performance measure. But controllable profit is merely an absolute performance measure. It's an absolute performance measure, meaning it's a figure, and it might not be useful when you are comparing performance of divisions of different sizes. So in mitigation, what do? You calculate ROI. We calculated this, and we got the ROIs of, on division A it was 100 over 200. That's 50%, and on division B that was 54%. So we have got these return on investment. Now, the beauty about return on investment is that everything is brought to the lowest common denominator. By saying 50%, we are saying 50 cents per dollar of capital. Project A, it provided a return of 50 cents per dollar of capital employed. Project B, 54 cents per dollar of capital employed. So we're using a ROI as a performance measure. We said using a ROI as a performance measure, division B has performed better than division A if you are using a ROI as a performance measure. So the main advantage of ROI is that it is ideal for interfirm comparisons because it is a relative measure. ROI is a relative measure, meaning it is expressed as a percentage. So it's ideal for interfirm comparisons or for comparing performance of divisions of different sizes. That's a very good point. However, we then said a division may actually report a higher ROI, not because it is performing better, but notice the denominator for calculation of ROI, it's net assets. Remember, net assets means total assets minus current liabilities, or it's actually net book value of assets, then less current liabilities. Now that you have net assets as the denominator, it means a divisional manager may be tempted to increase ROI by not investing in net assets. It's possible that a divisional manager may be tempted to avoid, the divisional manager may be willing to increase ROI for the division by not investing in new assets. And when this is the case, we call it dysfunctional behavior. Dysfunctional in what way? Because the manager is now interested or taking action which is selfish, so to speak, is taking action which maximizes divisional ROI at the expense of long-term success of the company. And that is called dysfunctional behavior. Another thing is a division may report a higher ROI because it is depreciating its assets faster. Like if a division is using straight line method of depreciation, its assets would depreciate faster. And when the denominator, which is the net assets, is lower, the ROI will be higher. So you wrote that. Also, a division may report a lower ROI because it is using reducing balance method of depreciation. By using reducing balance method, your assets do not depreciate faster. They are depreciated gradually in small incremental amounts. And in so doing, you then report a lower ROI. So this one we discussed and we had fun. Right. And you still remember what we meant by controllable profit. Just a recap. I told you that there are alternative measures of divisional profit. And I said, you say sales. You have the notes already. I'm repeating in the interest of catching up with after we had been disturbed with network issues. We say sales. On sales, there are external sales. External sales. You have external sales here. You also have internal sales. Internal. By internal, we are saying interdivisional sales. Internal sales or interdivisional sales, where a division sells to another. Then we say less variable costs. Less variable costs. And the answer that you get, is contribution for the division. Contribution for the division. That's what you get here. You get contribution for the division. Like this. Oh, sorry, yes, contribution for the division. And then you say less controllable fixed costs. Controllable fixed costs. Less controllable fixed costs. The answer you get is, if you take out controllable fixed costs from this, what you get is, you get controllable profit, controllable profit, controllable profit, and then you less non-controllable costs or non-controllable costs, controllable costs. If you take out all non-controllable costs, the answer you get is divisional profit before tax. Divisional profit before tax. Divisional profit before tax. Now, I said of all these profit measures, the one which is ideal when you are measuring money performance of a divisional manager is controllable profit. Why controllable profit? Because controllable profit, it includes revenue and expense items which a manager can control. It excludes those things which you can't control. So, Kudzashi, if you are given that a division made a profit of, let's say a division made a profit of 8 million, but when a division made a profit of 8 million, that profit includes depreciation, which a divisional manager cannot control. So what do? You say 8 million. If you want to find controllable profit, and you are told that we deducted 8 million that a divisional manager can't control. So what it means is, what it therefore means is, you say 8 million, add back depreciation. Because controllable profit we must not deduct expenses that a manager can't control. If those expenses are deducted, they are added back to get controllable profit. If those expenses are yet to be deducted, they are ignored. You get that? If the expenses are yet to be deducted, like in this case, if we are given contribution and non-controllable costs are yet to be deducted, you just ignore them because they are yet to be deducted. If they've been deducted, you add them back to get controllable profit. Now, so you do notice that ROI is susceptible to dysfunctional behavior. where a manager will take decisions which increase divisional ROI, but this decision might be at the expense of long-term success of the company. A classic example is when a manager is reluctant to invest in new assets. When a manager is reluctant to invest in new assets, is actually having a dysfunctional behavior because it's being selfish. So how do we mitigate the problems associated with ROI? We calculate what is called residual income. Oh, sorry. Still on ROI, there are some points to note. NB, if capital employed is average net assets, use average net assets. If capital employed, if the capital employed is average net assets, comma, you use average net assets as denominator. Average net assets as denominator. You use it as denominator. Simple. If the examiner says use average net assets, you just have to use average net assets. So how do we calculate average net assets? We calculate it as average net assets. Average net assets equals, you say opening net assets plus closing net assets over 2. That's we calculate average net assets. Opening net assets plus closing net assets, you divide that by 2. So this is quite cool, right? This if there are some assets which are not controlled by the divisional manager, are assets which are not controlled by divisional manager, are not controllable by the divisional manager, controllable by divisional manager, they are excluded from net assets calculation. Excluded from net assets calculation. Clearly, if you don't control some of the assets, we can't use all those assets to calculate your ROI. No. If there are other net assets which are not controlled by the divisional manager, they are excluded from the net assets calculation. And you need to know that by net assets was capital employed, which is equals to total assets minus current liabilities. Total assets less current liabilities. Total assets less current liabilities. So you may not be given net assets as a figure. You may still be required to calculate it. If you are required to calculate it, that's it. If you are asked to use average, use average. If you are told that some of the assets are not controllable by the divisional manager, exclude them in your net assets calculation. We only include assets that we control, because we are measuring divisional performance. You can't measure divisional performance using something that a manager can't control. Now, there is what is called residual income. Residual income. You know, write this. This measures amount remaining from controllable profit. Amount remaining from controllable profit. Remaining from controllable profit. Profit after deducting cost of capital charge. Amount remaining from controllable profit after deducting cost of capital charge. Okay, let me just get a glass of water to come in. Right, I'm back. So we are saying residual income, or RI in brackets. You know, ROI, it's return on investment, but it can be return on capital employed. It's the same thing. Residual income, or RI, it is the amount remaining from controllable profit after deducting cost of capital charge. So it will be like this. This is how you calculate it. You say RI equals residual income equals controllable profit less cost of capital charge. Controllable profit less cost of capital charge. That's the formula for I. And then cost of capital charge equals cost of capital charge equals capital employed multiplied by cost of capital percentage. So you'll be given the R percent. It will be like R percent. Like this. That's how you calculate cost of capital percentage. You say capital employed multiplied by the cost of cost of capital charge equals capital employed multiplied by cost of capital as a percentage. Now, as an important thing, the capital employed is the same denominator that we have used in a ROI calculation. So important. Capital employed, it will be the same denominator that you have used when you are calculating ROI. You don't change it. Now, for these two divisions here, actually, if you don't mind, if I can freeze panes, to right, so that we still continue. See, oh well, let me freeze. Let me let me unfreeze panes and freeze it somewhere here. Right. If I can freeze them somewhere, it makes sense. So that we continually see them. So for these divisions, we are saying division. So we have got division A and division B. And then we have controllable profit. Controllable profit is 100. And then we have 75. And then we say cost of capital charge less cost of capital charge. Cost of capital charge. Cost of capital charge for division A. For division A, it's 12% times 200. Remember, it's 12% multiplied by 200 because it's a cost on capital employed. So here you get 24 minus 24. And for division B, you say 10% times 140. 10% times 140. If the rate is the same, you just use the same rate. It's not given that the rates should be different. No. In an exam, expect rates to be the same. To be told that cost of capital is is 15% for both divisions. Here I have just used different rates for just expedience and convenience. So what you get after deducting cost of capital charge is what is called residual income. Residual income, right? So residual income is the amount left from controllable profit after deducting cost of capital charge. So easy. So easy. So how do we interpret this? You can then now say using residual income as a residual income as a performance measure, using residual income as a performance measure, comma, division A has performed better than division B. Division A has performed better than division B. So that's when you are using residual income as a performance measure. But so what are the advantages of residual income? Let us have advantages. You know, the reason why we are saying this has performed better, it's like this. Shareholders or investors, they merely required 12% on their capital that they invested. Meaning, for division A, they just wanted a minimum return of 24 million. If these figures are millions, they wanted a minimum return of 24 million. But the division satisfied their minimum return and added 76 on top. No wonder why we are saying residual income. The higher the residual income, the more or the better the performance of the division. You get it? So, what are the advantages of residual income? Number one, it mitigates a risk of dysfunctional behavior. The risk of dysfunctional behavior associated with ROI. Because notice, if we were giving bonus based on ROI and say we are giving bonus for a ROI which exceeds 50%, that's the condition for bonus. Are you noticing that Division A manager was not going to get a bonus? Using ROI, Division A manager was not going to get the bonus because Division A's ROI was very lower than Division B. But can you imagine, we are not giving manager of Division A bonus, but look at the controllable profit, 100 million. So the manager of the Division A may then say, why is it I had a lower ROI? We said the manager of Division A may say, perhaps I am using straight line depreciation. I'm using reducing balance depreciation. Perhaps I recently acquired new assets, so I will never acquire new assets again. And we said that is called dysfunctional behavior. Another advantage of ROI is that it's an absolute measure of performance. It's an absolute measure of performance and easy to understand. An absolute measure of performance, and therefore easy to understand. It's easy to understand, right? Because everyone, you know, ROI is a relative measure, meaning it's difficult to understand. I said it. ROI, it's a ratios I have got two terms. Some are called absolute, meaning these are actual numbers. They are actual figures. monetary amounts. Monetary amounts. Then there are relative, other figures which are called relative. These are called percentages. These are given as percentages. So when you are measuring performance, we use relative figures. If you are comparing of two divisions, two companies, or even if you are comparing movement, it is always recommended to put figures in percentages. But once figures are in percentages, they are difficult to understand. You know, you can have 80% ROI, but you might have just earned $1. You know, if I give you $1 and you earn $80, your ROI is 80%. But someone may have 10% ROI when that person had $10 million. So percentages or relative figures are easy to are useful when you are assessing inter-firm comparisons, because they bring everything to lowest common denominator. In other words, percentages compare everything to dollar. So when you are comparing performance, they are easy, but they are difficult to understand. When things are in percentages, they're difficult to understand. You know, 80% means 80 per dollar. So you can have 80%, but your profit being dollar, 80 cents. But I may have 10%, yet I have generated 10 million. So percentages or relatives are good for inter-firm comparisons, but are difficult to understand. Figures which are absolute, like these ones now, these ones are easy to understand, but they are difficult for inter-firm comparisons. So you can say disadvantages of RAI. This is advantages of RAI. And then we come to disadvantages. Advantages of RAI. So the disadvantage of RAI, I'm just trying to just have two for you to understand. First disadvantage is that as an absolute measure, of performance, it is not ideal for inter-firm comparisons. It is not ideal for inter-firm comparisons of different sizes. For inter-firm, by firm we can say division, comparisons of different sizes. That's what we are saying. You might not use it really for comparing performance of divisions of different sizes. Another is, RAI is a profit measure. Even ROI, it has got this same disadvantage again. As a profit measure, it can be manipulated. As a profit measure, it can be manipulated. These are the alternative profit measures of divisional performance. Everything we're doing here, it's like profit measures of divisional performance. You can measure profitability of a division using controllable profit alone. But controllable profit is an absolute measure. So it's easy to understand, though it's not ideal for measuring performance for divisions of different sizes. How do you go about it? You compute ROI, return on investment. This measures controllable profit per dollar of capital invested, and we calculated that controllable profit over net assets or capital employed. But if a division is investing in new assets, it may end up reporting a lower ROI, thereby discouraging a divisional manager to invest in long-term success of the company. And we called that dysfunctional behavior. It's not good. And then in mitigation, you calculate ROI. But again, remember, RAI is an absolute measure, so it may not ideal for interfirm comparisons, though it is easy to understand. Now, if you look at this shaded in green here, which I have just highlighted, this part here, this part is so important. Where, how do you calculate alternative profit measures? You do notice when you are calculating the sales for a division, you say external sales plus internal sales. In other words, when you're calculating sales for the division, you calculate both internal and external sales. But when you're calculating sales for the company as a whole, internal sales are excluded. The reason being, internal sales, it's like when if you consider divisions to be subsidiaries, you remember, suppose, let us consider divisions to be subsidiaries. When you are consolidating, intergroup sales are excluded when you are calculating sales for the group. But when you are calculating for a division, internal sales are included when you are calculating sales for the division. And now a key thing arises when we are talking of internal sales, and that is called transfer pricing. When we are making internal sales, we say we are transferring. So the price we charge for internal sales is called transfer pricing. And when divisions are selling to each other, it's rare for them to stick to the market conditions, to the prevailing market conditions in the course of their transactions. Really, there are some guidelines which would set the price that divisions would charge to each other. Now, for present purposes, let us use, say, Chicken Inn and Baker's Inn. You know, these are divisions. And let us assume that these are divisions in the same company. Chicken Inn and Baker's Inn. Same company, two divisions. And let's say these divisions are profit centers, meaning their performance, the performance of divisional manager, is based on the profit which they have generated, be it RAI, or these are profit measures, controllable profit. In other words, these are measures that we shall use to measure performance of Chicken Inn manager and Baker's Inn manager. So here's the deal. If there are people from Baker's Inn who come to Chicken Inn for a meeting, and we give them the chicken from Chicken Inn, how much are we supposed to charge them? That's the transfer price now. How much are we supposed to charge Baker's Inn guys for the chicken that they have eaten? Yet at the head office, both of us are going to be measured. Our performance is going to be measured on the basis of profit. Now the question is, do we charge at cost? Do we charge at selling price? Do we charge at cost plus? Do we charge at what? Now these are the transfer pricing guidelines. If I am the manager for Chicken Inn and you are the manager for Baker's Inn, if you come and eat my chicken and I charge you at cost, and yet our profit our performance is being measured using profit, are you not seeing that if I charge you at cost, you will report lower costs and high profit at the head office? Because I have charged you at cost, I will report lower sales and lower profit at the head office. So your profit will become higher at my expense. So the general rule is, you notice that the chicken that you are eating from my division, there is a market for this chicken. Whenever there is a market for division's product, like you come to my division, you realize that there are plenty of customers waiting to buy this chicken. They are actually queuing outside, and you need the chicken. So if you am to sell my chicken to Baker's Inn, which is called transfer, I must charge them the market price because the customers are waiting for the same chicken. So the guideline number one is, whenever there is an external market exists for my product, I can only transfer to other divisions at market price. And this is important because I should reflect the opportunity cost that I incur by transferring. So market price captures the opportunity cost to me. So if I transfer at cost, what about the lost contribution? Because there's a lost contribution. I could have sold this chicken to my customer, and my customer is giving me contribution on this chicken. And then you want me to transfer those at cost. Who is going to bear the opportunity cost lost? So in order to make sure that the receiving division pays for my opportunity cost, I charge the market price to reflect the opportunity cost on my side. That's guideline number one. Guideline number two. So let us actually do it whilst we are typing so that it makes sense. Transfer pricing. Transfer pricing. Transfer pricing. Right, this is the price charged for interdivisional products. I mean for interdivisional sales or transfers. This is the price charged on interdivisional sales or transfers. This is a price charged on interdivisional for interdivisional sales or transfers. Right? That's transfer pricing. All right? Right? An ideal transfer pricing system must An ideal transfer pricing system must one, motivate the divisional manager. The transfer system must motivate divisional manager. This is feature number one. Transfer pricing system. An ideal transfer pricing system. You wrote that. An ideal transfer pricing system must motivate the divisional manager. That's number one. Number two, goal congruence. Must ensure goal congruency. Must ensure goal congruency. What does this mean? By goal congruency, we are saying ensuring that divisional performance is not achieved. Ensuring that divisional performance targets are not achieved at the expense of organizations' long-term goals. Divisional performance targets are not achieved at the expense of the organization's long-term goals. You have that? Another point as a benefit of transfer pricing, I mean the feature of a transfer pricing policy is that it must encourage divisional autonomy. Encourage divisional autonomy. Must encourage divisional autonomy. What does divisional autonomy mean? Ensure that the divisional manager, can act in the best interest of the division. The manager can act in the best interest of the division. Best interest of the division. right? Another, it must discourage dysfunctional behavior. It must discourage dysfunctional behavior. Dysfunctional behavior. Dysfunctional behavior, meaning a situation where divisional performance is achieved at the expense of other divisions. Divisional performance targets. Divisional performance targets are achieved at the expense of other divisions. At the expense of other divisions, or the manager being reluctant to invest in long-term success of the group. The manager being reluctant to invest in new assets. Reluctant to invest in new assets. Right, so these are some of the features of an ideal transfer pricing policy. Now, listen carefully on this one. NB, use these features when you are evaluating any transfer pricing policy discovered. Use these features. We use these features plus guidelines below, guidelines given below when evaluating a given transfer pricing policy. Evaluating any given transfer pricing policy, you use these features. Is it achieving these features? Actually, I am referring to them as features, but they are actually objectives. The reason why we have transfer pricing is to achieve these objectives. So I can say objectives of transfer pricing policy. That's why we need transfer pricing. We must ensure that it achieves this. You get that? So it's so important. So you use this. If a transfer pricing policy is demotivating a manager, it's not ideal. Now, when you are setting it, so let's say guidelines when setting the transfer pricing. Guidelines when setting some point charging, when setting or charging the transfer price. The transfer price. These are the guidelines when you are setting or charging a transfer price for a particular product that you are selling. Remember, transfer price is simply amongst the divisions. Right. So here's the deal. Guideline number 1. You should remember these guidelines. When there is an external market for the division's product, when there is an external market for divisional's product, external market for the division's product, comma, the transfer price, then transfer price must be equal to market price. Of course, in some texts they say competitive market. It's still the same. It's still the same. The transfer price must be market price. Right? This is important in order to reflect the opportunity cost incurred by the transferring division. This is important in order to reflect the opportunity cost incurred by the transferring division. It's important in order to reflect the opportunity cost incurred by the transferring division. Right. So we are saying normally it will be market price or variable cost plus opportunity cost. That's what we mean. Some put it as variable cost plus opportunity cost. So we can actually put it as also defined as TP equals variable cost plus opportunity cost. Variable cost plus opportunity cost. So important. You know, an example of opportunity cost is lost contribution. An example of an opportunity cost is lost contribution. You can write that. An example of opportunity cost is the lost contribution. So this is guideline number 1. Does an external market exist? Yes. Then transfer price is the market price. Guideline number 2. Guideline number 2 goes like this. Guideline number 2, you say, if as a result of internal transfers, comma, the transferring division saves on marketing and distribution costs, saves, S-A-V-E-S, saves on marketing and distribution costs, saves on marketing and distribution costs, comma, then the transfer price, the market price must be adjusted to reflect such cost savings. The market price must be adjusted to reflect such cost savings. Must be adjusted to reflect such cost savings. The market price must be adjusted to reflect such cost savings. You get that? So it's like this. You know, if you are selling internally, there are some, suppose I'm buying from you and I'm another division within a company. You do notice that if I'm buying from you, we are both divisions. You don't advertise things to me because we are in the same company. I know what is there. So when you are selling to a division within the company, there are some cost savings that you make. You know, if I'm coming to collect things from another division, I can just come with my car and say, put everything in the boot. But when you are selling to a customer, everything must be nicely wrapped, nicely packaged, nicely, you know, when you are selling to customers, external customers, there are other additional costs you incur. But when you are selling internally, some of these costs you save. When you are selling internally, you may not actually deliver the goods. I may come and collect them myself at no extra cost to you. So you can't then charge me the market price per se if you are saving. Otherwise, you are now making money out of me. If there are some cost savings that we are having, you have to deduct them from market price. To be fair, because you are saving those costs because you are selling to me. So the transfer price becomes adjusted market price. So it will be like this: adjusted market price. Adjusted market price equals, you then say market price less cost savings on internal transfers. Cost savings on internal transfers. That's adjusted market price. Market price less cost savings on internal transfers. So that's it. Then guideline number 3. Just want to give you basic guidelines. This is guideline number 3. All right, number 3. It's if there is no external market, when there is no external market, for the division's product, then market price doesn't exist. Or let's just say then the transfer price should be at the cost of production. The transfer price can be at, so you can say the transfer price can be at cost of production, or it can be at cost plus a markup, or it can be negotiated, or it can be variable cost. All these are ways, whenever there's no market price for the division's product. The bottom line is, you can't say the division does not have market price and then you say, I want to sell to you at market price. When you are producing as a division, does not have market. In other words, there's nothing like market price. Or suppose you are producing 10,000, but the market is only there for 8,000 units. It means the other 2,000, they don't have market. So you can't charge market price for the 2,000. Are you getting it? We are producing 10,000 as a division, but the external market is only there for 8,000. So the other 2,000 do not have a market. The other 2,000, they don't have a market. So if the other 2,000 don't have a market, what it would mean is, you can't say you want to charge market price on those as if they can be sold outside. No, you can now charge cost of, there are various ways there. You can charge variable cost, full cost plus. You can negotiate with other managers. You can negotiate actually. You can actually charge. So I said negotiated, or you can charge variable cost, etc. But in final analysis, when you're doing all that, you must make sure that the guidelines or the objectives of transfer pricing are being met. You must not take advantage of the fact that the manager is selling something which doesn't have external market and then try to make gain out of that manager when that manager's performance is being dampened because of you. Another thing is, there are divisional managers who take advantage that their product doesn't have a market, and because they are charging, we might be making drinks and your division manufactures bottles for these drinks, and these bottles cannot be sold outside. So you may take advantage of the fact that, look, whatever cost you are incurring, you shall hand it over to the other division. So in mitigation, normally, when we say we charge at cost, we mean standard cost, not actual cost. So that if you transfer to a standard production cost, standard markup, cost plus markup, standard variable cost, the reason is we don't want a situation where you become wasteful, hoping that you shall ship all the costs to the other division. No. So we also need to measure your performance by variable cost, by variance analysis. So we want you to charge the other divisions at standard cost. Are we together? Not actual cost, otherwise you'll be wasteful and ship on the cost to the other division. And that will not be ideal. So you can write this as NB on that point. Standard costs, write this. Such a division must be designated a cost center. Such a division must be designated as a cost center. A cost center. A cost center. And standard costs must be used. You know, standard costs must be used to discourage waste. Must be used as must be used to discourage waste from the transferring division, to discourage wastage from the transferring division, wastage from the transferring division. Right. So these are the three major transfer pricing guidelines. If you can only know these, you're woman right. Now let us now look at something else here which is very important as well. It's like I have said, internal transfers are not, when a division sells to another, it's not a sale to the company. Remember, you did the consolidations. Intergroup sales are not sales for the company. In the same vein, if a division transfers goods to another, from the receiving to the receiving division, that's a cost. To the transferring division, that's a sale. So it is excluded from sales for the company. It is also the interdivisional cost is excluded from costs of the company. Right. So we said up to what? Let me now have a question. I'm sure it would make sense if I have a question or so. Allow me to have a question. You know, I have to open quite a lot of papers in search of that in search of the question. Let me check on these ones. Right, this one is talking about transfer pricing. Okay, so it's March-June 2018. March-June 2018 question paper. Yes. March, June 2018. I want also to, all right. I just want to do with you this one, and then I'll, no. Let me, if possible, let us find another and make them at least two. Two questions, I'm sure will play the trick. This is variance analysis. You know, not this. Let me try to find another question. December 20, September, December 2017. March 2017. This one is not. September, December 2018. There was nothing on that sort. PM. September, December 2017. September, December 2019. Well, this is not. All right. Okay, let me check once more on this paper. So this one is not, okay. So let me now just give you this one. You know, I wanted to give you this as an assignment, but I'm being forced now to give you this again. Right. One wonders what is happening with this paper. It's not opening. All right, let me check on this one. Right, this one has got divisions as well. Divisional performance. So I want you to do this sports company as an assignment. As soon as we finish our lecture, you must do sports company whilst you are in the study room. And oh, someone was asking, am I sharing my screen? Are you now seeing the screen now? Stanley, are you seeing the screen? Okay, because whenever you're not seeing the screen, what you do, a quickest way of solving it is to exit and join. You just exit the group, immediately join. That's it. You'll be already seeing the screen because it's a matter of boosting the network. So this paper, sports company, I want you to do sports company as an assignment. As soon as we are done, this sports company, I want you to do it as an assignment. It's question number 32. We did, the 31, the other question, we did it in class. So this is not an assignment which you need again to, what's this? I don't know. This is not an assignment which you need to do it like slowly in the schedule of your other assignments. It's an assignment, it's a 20-minute assignment. As soon as we are done, just do it and send me screenshots of where you have written it. Don't send on email or WhatsApp or what. Just send me screenshots. Find a rough piece of paper, do it quickly, take a picture, send it to me. That's what I want. I don't want you to schedule it like the other assignment I have to do it. No. That's question number 32. It's an assignment question. Then the question we want to do today is on transfer pricing, which is question number, which is March, June 2018. March, June 2018 question paper. March, June 2018. Why is it keeps on disappearing? So there you go. We want to do a question in that paper. So this one is done. You do it as an assignment. I'm closing it. Now what I want is March, June 2018, which is this paper. All right. What's wrong with this paper? It's not opening. Let me open it again. Right. So I'm sure it's opening on your side. So I'm reading. Portable Garage Company, PGC, is a company specializing in the manufacture and sale of a range of products for motorists. It is split into two divisions. The battery division, which is division B, and the adapter division, which is division A. The division B sells one product, which is a portable battery chargers for motorists, which can be attached on the car's own battery and used to start up the engine when the car battery fails. Division A sells, so division A, it sells what, B sells what are known as portable battery charger. So a battery will need that charger. So division A sells adapters. Now, after getting a charger, you then fit it into the adapter. Division A sells adapters, which are used by customers to charge mobile devices and laptops by attaching them to the car's internal power source. You know, that car adapter we use when we are using in the car to charge. Recently, Division B has upgraded its portable battery so that it can be used to rapidly charge mobile devices and laptops. The mobile device or laptop must be attached to the battery using a special adapter which is supplied to the customer with the battery. Division B currently buys adapters from Division A. It's important to understand Division B currently buys adapters from Division A which also sells them to external customers. So division A supplies division B. That's what it means. And also division A sells to external customers. So this is division B. Remember, we are told that it buys adapters. Division B buys adapters from division A. So here's the deal. Adapters bought from division A are being bought at $13 per adapter. And remember, it's not just getting adapters. It's all division A after division B. After getting an adapter, it then fits other materials. It's like you are manufacturing calculator. You get a cover from division A, but it does not mean that the only material is the cover that you are getting from division A. You also have to add some materials after getting others from division A, which are called other materials from external suppliers. And then you assemble these with labor costs and fix the costs are. Now, the maximum, remember division A, division B get adapters and then attach the adapter to a battery and then sells to customers at $180. But its maximum external demand is 180,000. And then it can sell 180,000, but its annual production is 150. So it tells you that it is failing to meet external demand. Because annual production is 150 and actual demand is 180. This tells you that division B is failing to meet external demand. Actually, external demand is in excess of production. Now let us go to division A. Division A can sell adapter outside. It has got external sales at 15. But it can also transfer the adapter inside to division A to division B at 13. So you have that. There is external selling price 15, internal selling price 13. Cost of production, variable cost is just 7. Labor plus material 7. Then fixed the cost is just 2.2. And then you are told annual production of division A is 350. So division A has capacity to produce 350,000. But of the 350,000, its maximum external demand, it cannot sell externally above 200,000. So if you can produce 350, but your external demand is limited to 200,000, it means the other 150,000 you have no market externally. So the 150,000 units which have no market externally are these which are now being transferred to to B. This is the 150,000. So A can produce 350, sell 200 externally, and then supply B with 150. Get that? In addition to the materials and labor costs above, division A incurs variable costs of $1 per adapter for all adapters it sells externally, meaning it incurs. This statement means when we are selling externally, we incur $. When we are selling internally, we save $. That's what it means. If $1 is being incurred on external sales only, it means $1 is being saved on internal sales. Currently, head office purchasing policy, this is now transfer pricing policy. Currently, head office purchasing policy allows division B to purchase adapters from A, but A has refused to sell division B any more than the current level that it is supplying to it. So it's like A is producing 350, external demand 200, and A is selling to B 150. But A is saying we cannot supply more than 150. That's what they have been saying. The manager of division B is unhappy, meaning the transfer pricing is not motivating. He has a special industry contract who he could buy adapters from exactly the same price charged by A if he was given autonomy to purchase from outside. So we are told that Division B is saying, look, I am unable to satisfy my demand with 30,000. The reason is you are preventing me from buying outside. Yet I have someone who can supply me from outside at the same price which A is charging me. You know, that's what Division B is saying. Look, my market demand is 180,000. I am only buying 150 from A. You are preventing me from buying another from outside. Yet I have an outside supplier who is able to supply me exactly the same price which A is charging. If you had given me autonomy, meaning if you had given me the right to choose. Now, after discussions with both divisional managers to ensure that the managers are not demotivated, the head office has now agreed to change the purchasing policy to allow Division B to buy externally, provided it optimizes profits for the group as a whole, meaning provided it does not affect goal congruency. Now, under the current transfer pricing system, prepare a profit statement showing profit for each division and for the portable garage as a whole. Your sales and cost of sales figures should be split into external and interdivisional sales where appropriate. So you are just using current divisional policy, you're not transfer pricing policy, you're not changing anything. So under current transfer pricing policy, so it will be like this. It will be like this. This is the profit statement that the examiner requires. This one shaded in green. But of course, there is nothing like controllable, non-controllable, etc. in this case. So what you do is solution. So illustration is March, June 2018. Illustration is March, June 2018. Question number, I don't know. Question number what? For them to check. Question number 31. Question 31. I told you, all you can simply do is to listen and then take a screenshot after we are done. I'm sure it makes quite a lot of sense that way. You listen and then take a screenshot after we are done. Because it is listening which is important, not copying. Copying is not an issue. You can still take a screenshot and copy. So you have got division B. You write divisions in their order. Division B. We have got division A. Then you have got portable garage company. Portable garage company. That company is a whole. So you put it like that's question A. You put dollar signs. You know, everything is premised on the basis of neatness. Then you say sales. Sales. I told you, you say in sales. Then you say external. External sales. What we want is external sales first, then internal. So sales external. You come to the question. External sales are like this for division B. Division B is selling everything external. Notice, we are told that maximum annual demand is 180, but you are producing 150. So it does not mean you sell 180. Otherwise, you are selling what you are not producing. You sell what you are producing. Kuzash. So if you want to multiply $180, you multiply $180 by annual production and sales. It's important to make sure that sales are based on what is sold, not maximum external demand. No. So it's 180 times 150. That's for A. External. So under external, you say 180. That's for B. So $180 times 150K. Then for A, external sales are, remember, external sales are maximum external demand. It's 200. So for A, we are producing 350, but maximum demand is 200. So we are meeting demand. So you say 200 times 15. That's for A, external. 200. So you say here equals 180 times 150, 123. For A equals 200, 123 times 15. Then you add. For portable garage, you add equals this plus this. Because they are both external sales, so they are added. Okay, it's 200,000. So it's 30 million. Then you say internal. Internal sales are transfers to B. Internal sales. So it's only A is transferring 150K to B at $13. So this is internal. It's only on A equals 150, 123 times $13. That's internal. And then you put a line to find total sales. Though in the exam this might not be necessary because you'll be under serious time pressure. So you can still find your sales as they are. But so notice internal sales are not added here. They are not added. Then variable costs. Then you say variable costs less variable costs. No, variable costs are quite a lot. When we sell internally, we are all to the receiving division. It's a cost. So you say internal transfers. Internal, or simply say transfers from A. Transfers. Oh, sorry, internal sales were supposed to be under division A. Under division, because A is the one which is selling internally. So it's 150, 123 times 13. They are not under B. Right. Now, on variable costs, you then say transfers from A. Transfers from A. A transferred this, so you say equals minus this. So it's a cost, it's an income on A, but it's a cost under B because B is receiving. It's an income under the one transferring. It's a cost to the receiving. Then you say direct materials. Direct materials. Notice direct materials. Materials are incurred when we are producing, not when you are selling. So direct materials are based on production, not on sales. Even direct labor, these are production costs. So direct material for B, it's 150 times 45. For A, it's 350 times 3. Sure, you get that? You take production. So for B, it's 150K. It's 150,000 times 45. That's for B. For A, it's 350 production K times 3. So this is your direct material. Now you go to direct labor. I'll sort out the actual figures. In exam, you don't just write DL, you write in full. direct labor, notice, for B, it is based on production. It's 150 times 35. For A, it's 350 times 4. So direct labor for B, it's 150K times 35. For A, it's 350K times 4. So let me put the figures now. Equals minus 150, 123 times 45 minus 150, 123 times 35. Then on that one equals equals minus 353 times 3 and equals minus 350, 123 times 4. Then portable garage, you add these. This, you don't add internal. Internal are not added. Then we are also told that whenever A sells to external customers, it is incurring additional dollar. It's a variable cost. So it's a variable selling cost. Variable selling cost. When A sells to external customers, it is incurring additional dollar. That's 200K. Remember, external sales, it's external demand. 200K times dollar there. So A is incurring additional minus 200, 123, right? And because it's external, it's also added under portable garage, minus 200, 123, right? Now, contribution. Nicely, you get your contributions. You get that? And then you say less fixed costs. This is where your 9 marks are. Contribution. And remember, the question is just 20 marks. So already you are 9 marks. All that is required is for you to score another 1 mark for you to pass this question. Contribution. And then you say fixed costs. Fixed costs, you come to the question. It's 5460 and 2.2. 5460 million and 2.2. So you say equal minus 5460, 123. There, 2200, 123. 2200, 123. And then, so it's equal. So equals this plus. So there you go. And then profit. Profit. You are done. Profit. You are now adding this up. So that, no wonder why I was saying your duty is to take a picture at the end of the day. Just take a picture. At the end of the day, you take a picture. All you do is to do the listening. That's what is important. In your exam, you don't have all these lines. What you only have is bold. So don't worry about these lines in the exam. Don't even try to look for them. All you have to do is to bold. If you feel like this figure is prominent, just bold it. Now, next point says, next question. Assuming that the new group policy, the new group purchasing policy will ensure the optimization of group profits, calculate the number of new adapters which B should buy from A and the number of adapters which A should sell to external customers. So it's like this. New policy is now saying, new policy, is now saying B can buy externally. It's now possible for B to buy externally. And they are saying provided it optimizes profits for the group as a whole. Now I want you to understand something. Even if A is selling adapters to B at 13, but the cost to the group is just 7. Let me repeat. Even if A is selling adapters to B at 13, but the cost to the group is not 30. You know what? To sell to another division is like to transfer from one pocket to another. In A, you are producing at 7, but you are selling to B at 13. It does not mean the group is incurring a cost of 13 because these are pockets of the same person. The group is incurring just 7. So what you then have to do is like this. The question says, the question then says, discuss. So the issue then now is like this on B. Let me say B. Current cost to the group. Current cost of manufacturing the adapters. Manufacturing adapters. Current cost to the group of manufacturing adapters is simply 3 plus 4, which is equals to 7. So currently it is costing the group $7 to manufacture the adapters. Because they want to know does it maximize group profit as a whole. Then cost of purchasing, cost to the group, cost to the group of purchasing adapters outside, cost to the group of purchasing adapters outside. So now if you choose to stop buying the adapters in-house and you purchase them outside, it's like this. Notice, pay attention. It will be $13 that the supplier will give us, less saving on internal manufacture costs, saving on internal manufacture costs of 7. So if we choose to buy adapters from outside, the cost is 6. The outside supplier will charge us 13, but remember we are no longer manufacturing them in-house. So even though the outside supplier is charged us 13, we have saved 7 that we were going to incur if we were manufacturing in-house. So cost to the group of buying adapters outside, it will be 13 charged by the outside supplier, less the saving because we are no longer producing it ourselves. So the supplier effective cost is 6. So what then it means is contribution earned by A from selling outside. Contribution earned by A from selling outside. Contribution earned by A from selling outside. Notice, if A is to sell outside, it is selling at 15 minus 7 minus $. So contribution earned by A from selling outside is 7. right? If it is selling inside, it's just 13 minus 6, 13 minus 7, which is 6. So if A is to sell outside, it is earning 7. If we are to buy from outside, it is costing us 6. So what does that mean? This means the conclusion is it is better to buy from outside, and then A should satisfy its external demand first. You get it? Not what I'm saying here is if A sells outside, contribution is 7. If B buys outside, cost is 6. If B buys from A, cost is 7. So what makes sense there? What makes sense there is to allow B to buy from outside, because the cost is 6. If B is buying from A, cost is 7. So it makes sense to allow B to buy from outside. And then the rest, it will then buy from A. Now, A has got external demand of 200,000. So you then discuss and say, because the question is then saying, as part of your discussion, the number of adapters that B should buy from A and the number of adapters that A should sell to external customers. So write this. It is logical, therefore, it is reasonable. It is reasonable to allow B. It is reasonable to allow B to buy from outside. It is reasonable to allow B to buy from outside, and A and division A to satisfy its external demand first. Its external demand first. If you look closely there, if its external demand first, this is because it's cheaper to the group. Because cheaper buy from outside, $6. You know, it's just costing $6. Compared to the current cost of $5, of $7, sorry. Now the question then says, notice the mark allocation. 3 marks available for calculations, 3 marks available for discussions. So this is important. There are 3 marks for calculation, there are 3 marks for discussion. So what we are now, what we are doing, they are embedded in the discussions as well. So when you were calculating this, you were also discussing. So like what we are saying, when you are saying if we purchase from outside, effectively we are saving on internal manufacture costs. Therefore, the effective outside manufacture cost is 6. So you'll be discussing. This question can be answered in a variety of ways. Let me just open the marking scheme for that part of the question only, for B. I just want you to see that was the most prudent logical reasoning on that question. Most prudent logical reasoning on that question. So this part we got it right. Exactly. So you do notice here on B, I just want the reasoning. The reasoning it's saying, this part here, before I proceed, I'll tell you the rest. This part is saying, this is because the contribution per unit for division A's external sales is 7. This means that for every external sale it loses, it forfeits 7. So that becomes a cost. However, the incremental cost to the group of division B buying adapters from outside is 6, which is $13 less $7 cost of making them in-house. So it makes sense for division A to satisfy external demand first before selling externally. So this is what I wanted, this part here. So if you come to our understanding here, it's exactly what the examiner said, but presentation is different. The presentation is, if A is selling outside, it is earning 7. But if B is buying outside, the cost is 6. So what makes sense there? It makes sense for A to sell outside first because we are earning more, and then it is reasonable to allow B to buy from outside and A to satisfy external demand first. So what then means is A's external demand, or you write division A's external demand, division A's external demand is 200,000, whilst its production capacity, production capacity is 350,000, right? Therefore, A must sell 200,000 externally, and 150,000 internally to B. Then remember, if B is buying 150,000, it is not able to satisfy its demand. Its demand is 180. So B should then buy 30,000 externally. B should then buy 30,000 units. 30,000 units externally. You are done. So it's important. So what is important when you are answering questions on divisional performance? Know the questions practically. Notice how I'm putting it. I am breaking down the question practically. Don't be hyped into theorizing everything and let it and cause it to remain bookish. You lose track of what is being said. Know the question practically. Like you at times just say, I am the manager for division B. I am. Take ownership. So it's like I am buying, or I am the manager for division A. I am selling to external, earning a contribution of 7. I am selling to division B, earning a contribution of 6. So to the group, the cost of selling to division B is 7. The external supplier is saying can sell direct to division B at 13. So as a group, the cost is not 13. It's 13 minus 7 that we are currently incurring. So if we get it from outside, it is cheaper because the effective cost is 6. So what is logical then? I must continue selling because the contribution outside is 7, cost from outside is 6. logical thing is I must continue selling externally until my demand is satisfied. And then the 150,000 which doesn't have external market, I then supply to B. But remember, B has demand of 180, not of 150. So currently B is not able to satisfy its demand. It then buys 30,000 from that external supplier. So break it down and understand it logically. Don't hype it and leave it in the book. Otherwise you will not get it right. Right. C. Oh, sorry. I need the question. So here the question is. Oh, notice already this was a 20-mark question. Already you are now at 15. You know, you can, if you know your stuff, you can totalize these like nobody's business. You can actually get these yet but this and you know you I don't know what goes in the minds of students. Please just practice questions, guys. Practice them until you are saturated with knowledge. You are saturated. I send you a question bank. Enter into the exam with that question bank complete. You know that question bank, I bought it. I bought the question bank I sent it to you 3 days ago. It's for your enhanced exam practice. All these are past exam questions. I bought it. And don't tell me that you are willing to enter into an exam without completing it. Because the questions in that question bank are the same in Vision Kit Kaplan, are the same in BPP. So, but in that question bank, there are other questions which I liked, and I said, well, I can just buy it. I bought it for $23 anyway. It was cheaper, but still, you need to do those questions. You know, when I realized that there are certain questions which are of examinative effect, and then I say, and I commented, they say, do this question bank and yet but your exam. These are the questions where you yet but break it down, understand it. Don't do questions as if you have never heard of transfer pricing. Aren't you in businesses having divisions where you transfer other goods to another division? Why can't you make management sense of the situation at the end to like transfer pricing? How can you solve it? This is the logical thing. If I buy it from outside, I'm earning this, I'm costing this. Put it in a logical way. You can see the reasoning coming out naturally. Notice, after saying 6, 7, 7, like what we have done, the reasoning came out naturally of what to do next. It's not like, oh no, under these circumstances, you must continue buying out. The reasoning will come out naturally. Cost of producing in-house, 7. If we buy from outside, 6, because it's 13 minus 7, meaning 6. Logically, let us buy from outside. It comes logically. It's not like it can be crammed to say, in these situations, let us buy from outside. No. You break it down logically. You see the answers flowing naturally. Right. Then another point is assume now that there is no external supplier for the adapters. There is no external supplier for the adapters. That's the issue. There is no external supplier for the adapters. Calculate minimum transfer price which must be paid for any additional adapters supplied by Division A to B so that Division B can still meet its max annual demand for batteries. Here's the thing, 2 marks for calculation, 3 marks for discussion. Please pay attention to how marks are allocated so that you don't leave other parts unanswered. Here's the deal. C is telling us that no external supplier exists for adapters. No external supplier. I'm not yet answering it. I'm just putting the issue down. No external supplier exists for adapters. That's the first point on C. Another point is Division B wants to satisfy its external demand. Its external demand. Division B B wants to meet its external demand. Now, if you come to the question nicely, you'll see this. Division B wants to meet external demand. So let me come to division B. Division B, it has started its, it once did last time this thing, and one wonders what the heck is happening in this software. Mine is not. All right, so let me close it and open it again. This is not internet thing. This is actually software. Computer. It's no longer an internet thing, I'm sure. All right. Now, here you have it. Now notice. Pay attention to your say. Molen, division B wants to meet its external demand. It means division B is currently getting 150, and now they are saying it must meet external demand. It means division B should now get 180 from A. The reason is there is no more external demand. There is no more external supplier. If there is no more external supplier, it means for division B to meet its demand, it must get additional 30,000 adapters from A. And now division A maximum demand was 200, and it was supplying 200. It was manufacturing 350, and then supply, after manufacturing 350, it was selling 200 externally, and then supply 150 to A. But now we are told to B, so now we are told that B must meet its external demand. What it means is A must take from 200, logically there, agree with your say there. For B to meet its external demand, A must now take the other 30 from 200. A must now take the other 30 from 200. But remember, 200 is the external market. So if A is taking 30 from 200, which is external market, we said, according to our transfer pricing guidelines, if you are taking something which is external market, the transfer price must be the market price. The transfer price must be the market price, because the additional 30 will be taken from 200, which is external market, meaning transfer price must be the market price. However, so external market price is 15. However, whenever A is selling externally, it is incurring additional dollar. But because it is now taking 30, which was being sold externally, and supply it to B, it means A is now saving that dollar. And the transfer price must be adjusted market price. You remember what we said? Because you are now taking from what you had external market and you are now selling internally. When you were selling externally, you were incurring additional dollar, but now you are selling internally, you are saving that dollar. So you don't supply at 15, rather you supply at 15 minus dollar, which is 14. That's the minimum transfer price. Simple as that. So you can simply say on C, for B to meet its external demand, for B to meet its external demand, comma, A must reduce its external sales by 30,000 units. 30,000 units to 170,000 units. 170,000 units. since these 30,000 units, since these 30,000 units are being taken from 200,000 where external market exists, the transfer price ordinarily must be the market price. By selling internally 30,000 units, the 30,000 additional units, additional units, A is saving $1 per unit. Therefore, the minimum transfer price must be adjusted market price, which is $15 minus $1, which is equals to 14. This is basic calculation, explanation. Alternative explanation is like this. Alternative explanation is that you say since market exists, since external market exists for the 30,000 units, transfer price must reflect opportunity cost. Transfer price must reflect opportunity cost incurred by A from failing to sell externally. This is one way of looking at it. The transfer price must reflect opportunity cost incurred by A from failing to sell externally. That is, i.e., lost contribution of, it's a lost contribution of 15 minus 3 minus 4 minus 1, which is a lost contribution of $7. So A by selling internally for something which has got an external market is losing $7. So transfer price equals, you then say variable cost plus opportunity cost. Variable cost plus opportunity cost. That's another way of looking at it, which is equals to $7 variable cost plus $7 opportunity cost, which is $14. So you still get to 14, whether you use alternative explanation or you use this part of this type of explanation, the answer will still be the same. You arrive at $14. That would be the minimum transfer price. Let me check. Right, exactly. So the minimum transfer price will be $14. So the examiner there used the alternative explanation, which is still fine. You get that? So I gave you an assignment. Just do it, guys. Just do it. Do that assignment. You know, the zeal must be in you, not in yourself. You are the one who must have the zeal. September 2017. Question number. Can someone take it from Skype and post in the WhatsApp group? Just do it, guys. Let someone take it from Skype and post in the WhatsApp group and comment that said we should do this assignment in the next 20 minutes and submit screenshots of the answers. Cheers. When you submit it after 20 minutes, after next 30 minutes, right? 30 minutes. If you submit it thereafter, I won't look at it because I want to know if you have been grasping what I've been talking about. Now, there are a lot of questions on divisional performance in your assignments. You know, the CBE practice platform assignments, quite plenty. I know you will come across quite a lot of questions therein. Cheers, guys. I have another lecture which is loading. Yes?
Can you share again that screen because we didn't take snapshots?
Oh, the screenshot. Well, it's fine. Either way, if you had not taken the screenshot, this will be streamed anyway, so you shall still see the video.
No, I just need the snapshots.
All right. Right. So you want to take you have taken it.
Okay. Yes, but from part I need the part A.
The part A, yes, here.
All right, thank you.
Right, you're welcome. So thank you once again for reminding me about the lecture. I was actually doing something else, and yeah, yet this was so important. Remember, I teach 28 subjects, and all of you guys are writing in March. Just imagine, put yourself in my shoes. CFA alone is 18 subjects. No, so putting CFA aside, I am its teacher, and if you only know me teaching ACCA, just imagine. I have got CIMA, I have got other lectures that I do. In total, they are in excess of 28. If we say even if they are repeated, it's another subject. All of you are making sure that you write in March. Just 3 months, I'm teaching 28 subjects. Now, can you compare? You are busy struggling with one. You are not even yet. You are not. You have got a lot of silly reasons for not doing assignments. I'm only seeing just a few people doing assignments, and you begin to say I am busy. Which busy do you tell yourself? Can you imagine? I'm talking of 28 subjects, and remember, I don't do this alone. This only. I'm a CEO of a company which does a lot of other things. Ask those who know what Atlantic Resources does. So if you are only 5% of how busy I am, then I can tell you that you are busy. But unfortunately, with one subject, you go to work nowadays, companies are closing at 3. You are busy giving reasons. It's a problem on your part. That can't be a problem with say. Please be, I am priming you. You know, if a vehicle is not, if a diesel engine is failing, is not starting, they use a language which they say priming, revving it. That's what I'm doing here. I am revving you, priming you for the job. Please stand primed. Momuka. Cheers.